Welcome to Financial News Daily. I want to show you three numbers. Not because they are dramatic. Because they are honest. 3.4. 289. 40. 3.4%, the annual U.S. inflation rate for July 2026, down from nearly 50% September rate hike probability the day before the data landed, now at 40%. CNBC. 289, the number of tons of gold central banks purchased in the second quarter of 2026 alone. A 74% jump year-on-year. A quarterly record. 40, the current percentage probability markets are pricing for a September rate hike. Those three numbers together tell a more complete story about where we are than any single headline from this week. Let me start with 3.4. 6 months ago, at the start of this year, the consensus forecast for July inflation was somewhere between 2.5 and 3%. The Federal Reserve expected to be cutting rates by now. Goldman Sachs had projected 4 cuts. The IMF projected global growth of 3.2%. Oil was expected to stay in the mid-70s. None of those forecasts survived contact with the year. The conflict began February 28. Oil surged. Inflation that had been declining reversed. The Fed moved from discussing cuts to discussing hikes. And the July number that analysts expected to come in near 2.5 came in at 3.4. 3.4 is better than 4.2, the May peak. But it is not 2. And the distance between 3.4 and 2 is not a small distance. It is a distance that the Federal Reserve's tools, interest rate hikes, are poorly suited to close when the primary driver is not demand but energy supply disruption. You cannot raise interest rates and reopen the Strait of Hormuz. The Fed cannot fix an oil supply problem with monetary policy. What it can do is reduce demand enough that lower economic activity pulls inflation down from the demand side. But that solution, engineering a slowdown in the U.S. economy to offset supply-driven inflation, has real costs for employment and growth that the Fed is not eager to impose if there is any alternative. This is the bind the three dissenters are watching. Beth Hammack, Neel Kashkari, Lori Logan. They believe the cost of waiting is higher than the cost of acting. The majority believes the opposite. Markets now see around a 40% chance of a rate hike in September, down from nearly 50% before the inflation data. CNBC. 40% is not nothing. It is not the base case. But it is not a tail risk either. It means that 2 out of 5 professional traders who put real money behind their views think the Fed hikes in September. And the number that will move that probability the most between now and September 17th is not anything the Fed says. It is August inflation, due September 11th. 6 days before the decision. Now the 289. Central banks purchased a quarterly record 289 tons of gold in the second quarter of 2026, a 74% jump year-on-year, according to the World Gold Council. This number does not get enough attention. Because it is not a price move. It does not appear on a trading screen. It shows up in a quarterly report that most financial media does not cover. But it is the number that tells you what the largest pools of institutionally managed capital in the world are doing, not saying, doing, with their reserve assets. Central banks do not buy gold because they expect the price to go up next month. They buy gold because they are making a long-term judgment about the structure of the global monetary system. And a 74% year-on-year jump in central bank gold purchases, in a quarter where retail investors were selling gold ETFs, is a very specific judgment. It says, the relationship between paper money and real value is less certain than it was. We want more of our reserves in something that no government can print. That judgment is not based on September's inflation print. It is not based on whether the Strait reopens this week or next month. It is based on a reading of where government debt levels are heading, where the credibility of inflation targeting central banks stands, and what the monetary landscape looks like over the next decade. Compare this to 6 months ago. In the first quarter of 2026, central bank gold purchases were already elevated. But the second quarter number, 289 tons, came during the period when retail investors were selling. When gold fell from 5,500 toward 4,000. When the headlines were about how gold had failed as a safe haven. While retail was selling, central banks were buying at a pace not seen in at least a generation. The people who understand that divergence, who is selling and who is buying at the same price, have a very different view of the current gold market than the people who are only reading the price chart. Now look at the second half of this year through the lens of all three numbers. If August inflation prints at or below 3.4, maintaining the 2-month easing trend, September hike probability falls further. The 40% becomes 30% or below. Gold extends its 10-week high rally. The 289-ton quarterly buying pace from central banks continues providing the structural floor. If August inflation prints above 3.7, because oil recovered through the month on renewed conflict, which is entirely possible given that Iran denied ceasefire negotiations this week, September hike probability rises back towards 60 or 70%. Gold faces renewed pressure. The structural floor holds, but the near-term price action gets painful again. The second scenario is not a low probability outcome. Escalating rhetoric between the US and Iran amid stalled negotiations further reduced expectations for an imminent agreement. The strait remains disrupted. August oil prices are not yet settled. The August inflation number is not yet knowable. CNBC. This is what honest analysis of the second half looks like. Two genuine scenarios. One number, August CPI on September 11th, decides which path we are on near term. And one structural fact, 289 tons of central bank buying in a single quarter, that does not change based on which path we take. The investors who will look back at this period most clearly are not the ones who called September correctly. They are the ones who sized their position to survive being wrong about September while participating in the structural case that central banks are expressing through the largest quarterly gold purchases on record. That is what the three numbers tell you. Not where gold goes in September. How to think about the range of outcomes between now and the end of the year. Everything here is for informational purposes only. This is not financial advice. Please consult a qualified financial advisor before making any investment decisions. All data from publicly available sources as of August 14, 2026. Three numbers. 3.4, 289, 40. Which one changes your view of the second half most? Tell me in the comments. We do this every week. Stay informed. Stay ahead. Financial News Daily.